Hello and welcome along to the third Lenders Round Table. This is a collab between Property Tribes Financial Services and the lending community. And I am joined, as always, by Victoria from Property Tribes Financial Services. And our guests today are Stella Brookman from Fleet Mortgages, of whom I'm a customer, by the way, and Stewart Green of United Trust Bank. So welcome to everybody. And as usual, with the Lenders Roundtable, we like to start with just a general roundup of what's happening on the buy-to-let mortgage scene. So Victoria, I'll come to you for that.
So yeah, lots happening. Property Tribes Financial Services is having a whole mix of different inquiries from a buy-to-let perspective. Lots of HMO inquiries, mixed bag, but a lot of large HMO inquiries. So people looking to convert to add to their current properties that they've got. Diversifying portfolios. So some landlords, even what was released with the budget, looking to purchase the holiday lets to diversify their portfolio, and some people looking to completely rejiggle their portfolios to try and bring their loan to values down slightly, so they get access to slightly better rates if they're under a certain loan to value. But it's good to see we're getting lots of first time landlords inquire with us. So yeah, lots going on. And
rates are continuing to come down, albeit slowly.
Very slowly, but we are starting to see the big boys start to reduce, which hopefully will then mean more and more will follow suit. So let's hope this continues.
Indeed. Well, I come to you first of all, Stella. Fleet Mortgages, very well-known lender within the buy-to-let space. Give us a little bit of a kind of background of Fleet and the type of products you have and the kind of client profile that if you particularly favour one.
Okay, well, hello Vanessa, hello everyone. My name's Stella Brookman. I'm a BDM at Fleet Mortgages. So Fleet Mortgages is predominantly a buy-to-let lender in the specialist market. We don't touch on commercial, Airbnb or holiday lets at the moment. Who knows what happens in the future? But for those that don't know, we are now owned by Starling Bank, which means we've got a strong funding route, can be extremely competitive with our rates. There's lots of funds flapping around, so we are now in the process of improving our portal. So that'll be music to a lot of brokers' ears, and also criteria expansion so that we can be playing in the big world with our competitors. Previous to Starling owners, we used to be capital market funded. So with that, there always became a bit of a risk as to whether funding was going to be pulled. Also, everything had to be securitized, so we couldn't offer PTs, which now as Fleet Mortgages under Starling, we do for all new business. So our main areas of business are HMOs, multi-unit blocks, limited companies, probably are 75% of our business, and portfolio landlords. So this is where we are very strong and have a massive amount of knowledge.
Fantastic. Well, great to have you on the call. And Stewart, let's come to you now and find out a little bit more about United Trust Bank.
Hi there. Yes, my name's Stewart Green. I work at United Trust as a key account manager. We entered the buy-to-let market fairly recently, actually, only about 18 months ago. The bank are a very well-established bank, have been trading since the sort of mid-50s, but the bank itself does development finance, bridging, structured finance, asset finance, and mortgages. And the mortgages side of things, we do for both first charge residential and second charge residential. And buy-to-let was the last piece of the jigsaw that we've added to that mortgages portfolio, as it were. We specialise mostly in the area where a lot of specialist lenders do. From the point of view, we do HMOs, multi-units, we do limited company, and we do holiday lets and Airbnb. Plus also we do some clients who maybe have had some credit hiccups in the past. So we cover quite a lot of areas. And I think, the majority of what we do is where we can help with some properties that some other lenders aren't quite so keen to lend on. So things like, flats above commercial property, or, houses opposite petrol stations, that sort of thing. So we do pick up a lot of cases where other lenders, especially in the mainstream market, aren't quite so keen to help with that sort of thing.
Oh, it's good to know. And Victoria, your relationship with the BDMs like Stella and Stewart, it is so important, isn't it? And knowing what their criteria is and placing, a client with the correct lender for what the client is trying to achieve. But, your relationship with the BDMs is kind of paramount to the service that you can offer people, isn't it?
100%. We could not do our job without Stella, without Stewart and the other BDMs. We just couldn't do our job without them. They are paramount to what we do. Even things like being able to have access to underwriters and speaking to them directly, because it's all very well having a case that fits on paper, but sometimes there might be some quirks with it that you need to explain to an underwriter so they understand the reason for X, Y, and Z. So having access to these guys, having access to the underwriting team, it just makes the whole process so much smoother. And that's where we benefit from sometimes getting cases through that wouldn't necessarily go through if we were just to submit the application and hope for the best.
Now we're going to move on to a couple of kind of hot topics that have been arising on property tribes in the last couple of weeks. And it's interesting because just recently we've had quite a few newbie landlords coming on who really struggle with the concept of taking on buy-to-let debt. They're trying to get their head around it and become comfortable with it. And some say, well, I want to stay unencumbered. That feels right for me, which is fair enough. But obviously, as lenders, you want to lend and you're happy with property as an asset to secure the loan against. And I think that's absolutely key to understanding leveraged buy-to-let and how powerful it is when you can work with a lender. What's your view on that, Stella?
Well, it really depends on the landlord's position, whether they're a first-time landlord, whether they're a portfolio landlord. Obviously, portfolio landlords probably have a lot more to play around with because they've got lesser LTVs. We offer interest-only, capital repayment, part and part. So whatever's suiting them and whatever financial space they're in at the time is something obviously they can consider, and they can talk through with their broker. When you've got a first-time landlord, it is exceptionally difficult to know the right way to go because they don't want to perhaps borrow or put more money on their residential mortgage in order to go into the buy-to-let market, which has been very vulnerable over the last couple of years. But it's still ultimately a good place to invest in bricks and mortar. So I think probably for them, the capital repayment route might be better if they're in a financial position and they can get the rental stress, because that's another thing. Rental stress has been so difficult for landlords over the past few years. And I think lenders have definitely taken that on board. And I do think going forward this year, we're going to see a little bit more reduction in rates. That's my personal opinion. So hopefully that will help. Stress rates are still sitting at the 145 for higher tax rate payers, 125 for lower tax rate payer. But also limited companies are quite a good choice with accountants to put properties in because they can get a better stress rate. Mm-hmm. So I do believe it all depends on the positioning of the landlord.
No, I totally agree with you. And that's one of the great things about property is that you can kind of customize it to your personal risk threshold, how you feel about things. And, there's nothing to stop a newbie landlord just taking out a 50% loan to value mortgage until they kind of feel comfortable with that and get into it. And then they can always, think about refinancing later. Stewart, what's your view on it? What do you kind of have an opinion that there's a comfortable LTV? Personally, I'm sitting at about 64% LTV across my portfolio, and that feels about right for me.
Yeah, I think it also depends on how long you've had the properties for, how you obtained them in the first place. I mean, funny enough, thinking about it, going back to the sort of mid-90s, if you like, a lot of people started doing buy-to-lets by actually renting their own houses out that they lived in, and then bought another one to move to, and then gradually doing this sort of let to buy route, started building up a portfolio. So, if you look at the most successful portfolios out there, they will have an element of mortgage debt because it's the best way of borrowing. I think if you're looking at how we fund property purchases in the UK, to do it all by cash is going to be very difficult. I mean, you could have maybe a couple of properties that end up being unencumbered, but you can always have them there to leverage some more money out, to buy other properties. So, I think over the last 20 years, maybe 15, most landlords have increased their portfolio by remortgaging and taking capital out of a property that's gone up in value and then bought another one and then done that again, and again and again. So I think the mortgage debt situation, I think if you're very cautious, then obviously, the mortgage debt is something you don't want. However, I think to run a successful portfolio, you've got to be sort of willing to take the risk of having mortgage debt. And as long as you're servicing it well and the rent that's coming in is covering the mortgage okay, then I think there's nothing to worry about. I personally, would look to buy more buy-to-lets going forward, and I agree with Stella. I think the interest rates are, getting cheaper. We've had 2 price reductions this year so far, and I think the view is in the market that the rates won't stay as high as they are now, and they will reduce even further, especially as the inflation rate drops. But I think generally, if people want to get into property, you have to borrow money to do it. I think it's the main way because obviously it's so expensive. But it can be a situation also where people will buy something with a bridge, and do it up and then remortgage that. So I think, having the finance is always important, but there's always going to be a fine line. And I think you've got a really good balance there of having sort of 65% LTV across the portfolio. And, what people don't want is where you're getting a portfolio at sort of above 80%, because then it gets a very difficult situation to mortgage and so on.
Indeed. And I think, as you mentioned, the only real way to scale up, unless you're a multi-millionaire with lots of cash, is to use buy-to-let finance. And over time, you could enjoy capital appreciation while at the same time your debt is being eroded by inflation. And then your equity cushion is increasing over time. And I like equity to work for me. I do not like large amounts of equity snoozing away doing nothing. So that's kind of how I look at it. Victoria, you mentioned you're hearing from quite a few newbies. Are they cautious about their loan to values, or is kind of 75% LTV feeling comfortable for newbies at the moment? Have you got any anecdotal kind of thoughts?
I think for a newbie, it's treating this like a business. So it's making sure that it's whatever decisions you're making, think about the big picture. So what do you want your portfolio to do for you? Do you want this to be your retirement fund? Do you want this to be left to your children or whoever to take over eventually? What's your plan for the portfolio? And then working backwards. So when it comes to investing in that first property, it might be that because of the size of the deposit needed and the price of properties, they might have to go for a 25% deposit. But as we know, if they've purchased in the right area and there's that growth in property price, when you come to remortgage and they want to borrow more in the future, it may be a case that you can remortgage, pull out some funds, but it might push you down to 65%. So that's what I mean by treating it as a business, because it might be that you have to look at certain areas where there's going to be good capital growth in that area. It might be looking at the type of tenant that you have in the property. It might be actually looking to you go into the HMO side where you can get a lot more for your money. So it's just working out the best option. As Stella pointed to earlier, is it better personal name or limited company? So getting advice from an accountant, and we can certainly meet with the accountants as well. So we're doing it all together, because the one most important thing which we've touched on before is if you are going down that limited company route, making sure that that limited company is set up right from the get-go, because it can hinder you from a mortgage perspective if it's not set up right in the first place.
Absolutely. And it's so important to get everything set up before you actually start acquiring properties, and do talk to a tax advisor and your mortgage broker and make sure that you're in the right setup for you, because as we said, you can customize property and buy to let a lot to your own goals and your own risk thresholds and how much time you have to deal with it and all that good stuff.
The other thing we do is having a fact find with the clients and working out exactly what their objectives are, and then giving them different equations, different sums. So if you put down a 25% deposit, this is the kind of rate that you're looking at, versus if you put down a 35-40% deposit, this is the kind of rate that you're looking at. The rental value isn't going to change depending on what deposit you put down. So then it's working out, how much profit they're making from that. So we can do that all from the get-go. So you know exactly what your figures are going to look like before you've placed an offer on that property.
Yes, that's a really, really useful exercise to undertake for sure.
Also, the other thing is, I think a lot of landlords, and maybe it's just what I've seen, but for first-time landlords, they've got to start factoring in the property expenses as well, not just the mortgage, but everything else that goes with it. And also to think about the kind of tenant they're putting in the property, because if there's any shortfall, they need to be in a position to be able to cover that. And I think some landlords, first-time landlords, might not always consider that straight from the off. So it's not just about paying the mortgage on the rent, it's got to be all the other aspects of keeping that buy-to-let afloat as well.
100%. And, there are many costs with being a landlord. And also, you've got to factor in voids as well. Can you cover the mortgage if the property is untenanted or the tenant stops paying the rent? So absolutely, these are all really important questions that we all need to ask and be aware of. Our next
Especially also if you get the new build flats, for example, and things like that, where you've got the service charges and the maintenance costs and things like that, which some people tend to forget about, and some of them can be quite high. So there's always that worth taking into account. I mean, the market is quite interesting at the moment because a lot of people are saying, well, interest rates are higher than they have been, but there's some good property bargains out there because people are looking to sell, and the prices have actually dropped to a point now where I think they're at their sort of point of not dropping any further. So I think this is why we've seen a bit more business and interest and activity since middle of January. So I think there's a good opportunity now to go out there and buy some properties which would have cost a lot more money, 18 months ago. And
it really does help if you can, achieve a significant discount, that makes it even more comfortable in terms of your LTV as well. So it's a good thing to try and achieve for sure. Our next question is kind of an evergreen topic at Property Tribes. And again, it's landlords trying to work out whether interest only or a repayment mortgage is best. Now, I fall in team interest only because in my case, I want to obviously live off the cash flow. For me, that's important to me. If you are not so dependent on the rental income and the net cash flow each month to live off, then you perhaps could consider a repayment mortgage. But to my mind, it's absolutely counterproductive. And also we know that interest only mortgages, most of them have the facility to pay off 10% capital per annum anyway, making you in control of when you pay off capital. So I'll just ask our two guests. Stewart, are you a fan of repayment mortgages, or are you happy with people choosing interest only?
Well, I would have to say, I mean, the market, buy-to-let market's always really been predominantly interest only. We do offer a repayment option, and we do calculate the rental cover based on interest only figures. So it's an option for the client if they want it. I think I can only think of a handful I've had over the last since we launched, actually, that have done a repayment mortgage on a buy-to-let. And as you rightly say, it depends on if you're earning a lot of money in your normal job, as it were, and you're looking really to pay the mortgage off by basically the rent covering the payment. That's sometimes what people would do. So, for example, if you're getting £1,500 a month rent and the mortgage payment was around about that figure on a repayment basis, then perhaps that might be an option. But I think with the interest rates much higher now, I think it makes it more difficult to make that work, and you might have to end up paying money out of your own pocket towards it. So it's quite rare, to be honest. I don't know if Stella finds the same, but at least there is an option to do it if people want to have that facility where the rent is reducing the mortgage outstanding balance down, and therefore creating that equity that people may want to use again in the future.
I agree with Stuart, actually. To be quite honest, I mean, I think it really depends on the situation of the landlord, but they've also got to check out the lender they're going to use, because if they are in an interest only to start off with, a capital and interest only, and then like we've had over the last year, rates suddenly start rising and they find themselves in a position where they're struggling because the rental's not stacking up, and they want to turn it down to an interest only, they've got to be with a lender that's happy to do that within their term period, like their fixed term period, because that could cause issues. So I think they have to be mindful of the lender and the criteria that the lender offers around their mortgage product they choose, their financial status. If they are, like Stuart said, in a job as well as their buy-to-let income, they're probably not in such a bad area as somebody that's just living off their land and property. So it really depends on their situation. But I would always say check the lender first before you make the decisions of which way you want to go.
And Victoria, is that a conversation that you would have with a client? Well, obviously it is, whether they want to do repayment or interest only. And do you have any kind of rough figures of, percentages of repayment mortgages that you help raise?
Yeah, so I do have a handful, I would say probably between 5 and 10% that want to go on repayment. And the main reason I have for that is because they want to leave their property portfolio to their children. So they're in limited company and they want their children, when they turn 18, to be part of the business, and that's their kind of contingency plan for their children. Now, I'm not a tax specialist, but obviously having it in limited company and then bringing them on as directors, then a tax specialist would be able to advise, whether that's tax efficient. I guess if it's in personal name, then if you've got a purely paid off property, then there's going to be potential inheritance tax implications with that. The majority of my clients are interest only, and as Stella and Stuart touched upon, it's down to stress testing, it's down to that worry of, if interest rates continue to rise and they've got their property on a capital repayment, is that going to cause them problems moving forward? As you rightly say earlier, there is the facility with a lot of lenders that you can overpay. Some is 10%, some is 20%. There's one lender that does 50%. So I know. So there is that option to overpay. And also when you come to the end of your deals, so, your 5-year, your 2-year deals, you might want to pay some money off of that mortgage. So you're treating it almost like capital repayment, but just in lump sums rather than in that monthly cost. That could be an alternative for people that want to look at paying that balance off.
Okay, well, I'm sure the debate will rage on because it's just one of those things that people do love to discuss, and obviously it's very important for newcomers to decide how they're going to go. Well, let's just round this off now by talking about a couple of trends that we've been observing in the lending space. And Victoria, you said before we started the call, you've noticed an increased interest in large HMOs.
Yes. So I've had a few inquiries recently where people are looking to take an HMO from maybe 12 bedrooms to 14, 15 bedrooms, so increasing that HMO. Tends to be in the student areas, so the real student towns, that's where they want the bigger HMOs. And it's really making sure that you've got everything in place if that's the route that you're looking to go down. From the council's perspective. So if there has to be a licence, but also making sure you've got the right planning in place, because whilst when we put the application in with the lender, if you've not got your licence through, as long as we can evidence that you've applied for a licence, that's acceptable. When it comes to the planning side, the planning has to be granted before we can put an application in with the lender, because obviously the planning isn't guaranteed. So it's just making sure that you've got everything set up, ready to go before you start then looking down the mortgage side.
So we're happy to do HMOs. They've got to have a licence in place, or if it's a new HMO, we've got to see that a licence has been applied for. Maximum rooms in the HMO are 6.
Okay.
So we don't go into the bigger HMOs at the moment. And the landlord has to have a minimum of 12 months rental experience, but that could be a 1-bedroom flat they've had. We do have a caveat, however, to HMOs. So especially if it's a first-time landlord wanting to go into the multi-occupancy area, which I think a lot of landlords are looking to do because of getting the stresses on rent. It's very difficult. But if you have a property with only 4 bedrooms or just 4 tenants, and it has a separate communal room, separate kitchen, and it doesn't require an HMO licence by the local council, we can do it as shared accommodation, and we can put it on our standard products, which means they get a cheaper rate. They get a free valuation up to 500,000, and the 12 months rental experience isn't required. So it's quite a good one to offer, especially if they want to get into that space as a first-time landlord.
That's very interesting to know. What are your thoughts on HMOs, Stewart?
Well, that we seemed very popular, as Victoria has mentioned. That we're seeing quite a lot of increased applications on HMOs. We go up to 10 bedrooms, and where we're slightly different from some lenders is that we will allow them to have kitchenettes in them. So basically, what I would call it's almost like a bedsit to some degree. And as long as it's got an HMO license, we're quite comfortable with those. The yields are fantastic. So this is why we're seeing landlords look at them. And the requirement is that they have to have 12 months experience, much like Stella has said. We quite see quite a lot where they're buying them again, coming from our bridging side, where they've refurbished an old HMO that's been around for years, and they're making it sort of quite boutiquey, quite a nice place to rent, so that the accommodation is very self-sufficient. What you don't want is 12 people trying to cook dinner all at the same time in one kitchen. So having the kitchenettes is quite useful, and I think it gives the landlord a good option for when he's trying to get these rooms filled. And in the most cases, these are in towns. They're mostly in towns and cities. We see them. Occasionally they're outside of that, but again, the student-let area is quite common. Our structured finance team, they can do much bigger HMOs, so they do the ones that the 20 rooms, student accommodation, that sort of thing. And again, that's quite a popular area. But we're seeing both multi-units and HMOs as a good yield-making opportunity. And this is where some of the portfolio landlords are branching out from just buying normal flats and houses. They're now looking at these to increase their yield, as well as things like holiday lets and Airbnb and multi-unit holiday lets as well. So trying to expand the whole portfolio. So it comes as a sort of range that what people want to do is have a spread of different investments, and I think this is where it's working for them.
Well, interestingly enough, I've just relet a room in my own home here in Guildford, and I did some research, and I came across a 6-bed HMO done to a very high standard, the boutique style HMO you mentioned, Stewart, which I believe is definitely the way to go. And that landlord was charging £1,000 per month for each of the 6 rooms. And I thought, wow, nice if you can get it. It was all fully licensed. It was very professionally set up, and it met all the criteria. So, it's definitely a very interesting area. But in my opinion, it's for people with a few years of standard buy-to-let under their belt, so they can kind of hone their skills of being a landlord and start understanding tenant selection and things like that. Okay, well, we're coming to the end now, so I guess I'll just finish off by asking our panelists how they feel about the next 2 or 3 months in the buy-to-let space. We may see the Bank of England base rate coming down. There's some hints that it might be. Stella, are you feeling upbeat and optimistic?
Yeah, I did. I started the year feeling optimistic about this year because it was so blooming awful the last couple of years. So yeah, I do think it's going to be better for buy-to-let and landlords. I think you're right. I think the rates will start coming down. I think it only takes one lender to reduce their rates and the rest will follow. Obviously, we at Fleet will be looking to do something with our rates, but they've also got to be very conscious of service levels. So it has to balance out. It has to be both happening. And I'm very, very positive. I think this year's going to be good. And I think next year's going to be even better for landlords. They can't have any more things thrown at them, bless them. But yeah,
No,
very, very optimistic.
But Fleet are always coming out with new products. And again, this is why we kind of always, saying how important the broker is, because the broker knows that a new product has come out this morning and it might fit for what you're trying to do. And I know Fleet have some really, really good products.
That's on the back of what the brokers have fed back to us. We listen and we take notes and we'll do what we can do to change things. So we've got fee-free products now in all different spaces. We did have green products. We've withdrawn them, but whether they'll come back again, and that's because the EPC is not reliant now. But yeah, so we'll do everything we can to help the landlords, and that's really down to the brokers' feedback.
Awesome. And you, Stewart, are you feeling optimistic about going forward, and will UTB be expanding more into the space?
Yes, definitely. I think that, so again, same as Stella, really. I think since the beginning of the year, it's been much more interesting. There's been more inquiries, and I think people are feeling more upbeat about the market generally. I think it's an ideal opportunity at the moment because, as I said earlier, I think house prices are now at a reasonable level. We can, with the rates as they are now, we're okay getting the loan sizes that people want. 80% on buy-to-let is still a challenge in most cases, but if rates drop again, it will make it even easier to make these rental covers work that we work out to give people their affordability on their loan sizes. So I think this is where this year's been much better than last year, because a lot of the inquiries we had last year, we couldn't quite get what the client wanted to borrow because of the rental cover on the higher interest rates. So I think that's really going to create more demand now, so people can borrow the 75% on the property they want to buy, and the property they want to buy is a little bit cheaper, and the rentals have gone up as well. So the rental market has increased on the payments. So I think overall, I think I'm very optimistic. I think it's going to be quite a good year this year altogether. It's still well down on what we did, in 2018 and that sort of time, when I think the market was sort of 40 odd billion. But this is now getting better and better, and I think another rate drop will make a huge difference to what we're doing.
Well, as you mentioned, rents are at an all-time high, and landlords have a very wide pool of tenants to choose from. In fact, just the room I mentioned that I've just started to relet, I put it on yesterday morning on Spare Room, and I've had, I think, 18 inquiries so far. More come in while I've been on this webinar. But my previous buy-to-let flat that I let about 3 months ago, I had 48 inquiries by lunchtime of the day, and that moved to 17 viewings and 5 offers. So it actually achieved above what I put it on for. So it was a very positive start to the year for me as well. Victoria, just a final word from you. Are you feeling good about the next couple of months until the next Lenders Roundtable?
Of course, always positive. Always. No, I am. I think landlords have had it tough for a long time. It's encouraging to see the rates slowly but surely coming down, and as we've touched upon, I do think there's going to be further reductions as we move on into the rest of the year. Just hold in there, hang on in there, everybody. We will get through this, and the biggest thing for us is lenders understand that, and thank goodness for the BDMs, because they do help us so much with trying to get those cases through.
Awesome. Well, we've got the Property Investor Show coming up at Excel in London very shortly, next weekend. I'll be there. Property Tribes will be there. And interestingly, they've got an HMO zone and a holiday let zone. So I think that just kind of reinforces what we've been saying about the popularity of these diversification strategies. So I will put a link underneath the video where you can get your free entry to the Property Investor Show taking place at London Excel. And I will look forward to seeing anybody from our viewership watching, see you there. But for now, for my guests on the call, all that remains is for me to say thank you so much for joining us on the 3rd edition of the Lenders Roundtable. It's been really great and much appreciated to have your insights. And we'll look to have you back again, in a few months' time, and we can talk more how things are going then as well. But for now, just thank you very much for being part of the Lenders Roundtable.
Oh, thank you. It's been a pleasure.
Thank
you very much.
Thank you. Nice to see everyone. Thank you.
Thank you. Bye. Bye-bye.
Bye.